This is Alan Bush with ADMIS. In the stock index futures, we are seeing some new highs for the move in the Dow futures and also in the S&P 500 futures. Of course, we are having the much anticipated very light volume, but nevertheless, new highs for the move. Over the last couple of weeks or so, we have seen a pattern where futures are overperforming the news. That in itself is a sign of strength. In addition, we do have the Fed's extremely accommodative policy. Even though the Fed has started their scale back of QE, there is still plenty of accommodation left in the banking system. So going into next year, I think we can see more of the same. Higher prices are likely for stock index futures. I'm not sure about the same type of gains that we have seen in 2013. But the fundamentals and the technicals suggest that we will see higher prices next year in stock indices. Over in the currencies, we are seeing the pound higher for the sixth day in a row. It still appears that the main trend is higher for the pound going into next year as the UK economy continues to improve and there is upward pressure on UK interest rates. In fact, the consensus view now is that the Bank of England will be increasing rates in 2015. By the same token, the yen, after making a 5-year low against the US dollar yesterday, was able to bounce a bit today. But the fundamentals are really not there as far as the economy is concerned in Japan, to the point where the Bank of Japan will probably add more stimulus next year. And of course, if there is more quantitative easing from the Bank of Japan, that would put downward pressure on Japanese interest rates, which in turn is bearish for the yen. So going into next year, I think the pound will be the best performer, followed by the euro currency. The weakest currency, we believe, will be the Japanese yen. Over in the interest rate markets, we are seeing signs that the U.S. economy is improving. We did have the consumer confidence number today coming in better than expected, although I think a lot of this is due to the Fed's accommodative policy, including the Fed's quantitative easing program. However, if the Fed does scale back, as many analysts believe, into next year, that a scale back of QE could possibly slow the momentum of the U.S. economy, and I think that could show up late in the first quarter or in the second quarter of next year. So in the first part of next year, look for higher interest rates and lower treasuries, but by the end of the first quarter, maybe the second quarter, I think that trend is likely to halt or possibly even reverse. We could start to see lower prices for interest rates, or I should say lower yields and higher prices for treasuries. So the first part of next year, I think the downtrend will continue in treasuries, but would not look for more than possibly a couple of months, 2.5 months of a drift lower in treasuries. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.